All right, young lady. I don't
Hello.
typically like doing coaching calls the
I
day before the
know.
exam, and I'm starting Christmas vacation.
I
So,
know. Thank you. Sorry.
what would you like to talk about?
Um, Winston thought it was a good idea to run into the street in front of a car when I was
Oh,
letting him
no,
out
you
to
okay?
use the
Did you get?
bathroom. Yes, he's fine. He knows he's in trouble. Yeah.
All right. Wow,
So
jeez.
he
Okay, before we start, though, oh, so cute.
he's in trouble.
That doesn't look like a bad boy or
Yeah.
bad. We got to send some love Sydney's way. Oh,
Yes.
mm.
Yes.
No,
I
she's.
know. I prayed for her this morning. She called me at 6:30 this morning.
Yeah, I told
And
her she's
then
anointed. She got the priest blessing. She's got mom has got her in the God box. You're saying prayers for her. So
yeah, so then she was freaking out. She told me she threw up twice.
I know. She's just, what are you gonna do? I
And
mean,
I was like, Sydney, you got to take a deep breath, slow down.
I
Like,
told her, I said, there's a lot of professional athletes who've had famous games when they had the flu games, like Michael Jordan, and he was had the flu and he scored
oh,
50 points. So I said, that's what she's gonna do. She's gonna,
yes.
it's gonna help her concentrate better. So
I told her, I said, trick your anxiety into thinking that like you're excited.
that's exactly it's the same, chemistry. So
Yeah.
all
Okay.
right.
Well, so I thought, um, I mean, I know today, like, I just wanted to review like um, mutual funds, like, kind of options, the conversion, like, parity
Yeah.
price, parity
Okay.
stuff, um, mutual fund options, the conversions, and then like briefly kind of on just like the orders, like slobs over bliss.
All right. So we'll start with convertibles. Let me go grab.
Ah, I'm so nervous.
Well, like we just said, it's you gotta, just use it to your benefit. All right. So the thing you're gonna have to do on your exam tomorrow is you're gonna have to calculate parity. And parity just means equal, and there's two parity calculations. Parity means equal, parity of the stock and parity of the bond. Right? So can you see my screen? Just a sec. Boom.
Yes,
Yeah.
Starbucks.
Right. So yeah. So this is a Starbucks convertible. So Starbucks issued this and said, we'll give you 6%, $60 in annual interest if you'll lend us $1,000. So that's $60 in two semi-annual installments. They said in 10 years, we'll either give you back your $1,000 or we'll give you our stock.
Hmm.
So it's important for us to know if we hold it, we may not hold it that entire 10 years, but if we did, how many shares would we get? So the number one thing you got to do before you jump in is say, okay, well, I need to know the conversion ratio. It's not meaningful to know that it's convertible at 40.
Yeah.
Meaningful is to know how many shares we can get. So we're going to take par, we're going to divide by the conversion ratio, or excuse me, conversion price. That gives us the conversion ratio. Now we're back in business because now we know that we can convert this bond into 25 shares of the common stock. That may or may not make economic sense. It certainly doesn't make economic sense when it was issued because when it was issued, Starbucks was 38. So when it's issued, the conversion price is going to be above the current market price, kind of like a warrant, right? Warrants have that exercisable above. What we're hoping is Starbucks takes the proceeds and makes investments and builds the business. Now, we could also figure out the conversion price by going the other way. Who cares? When I say who cares, I mean for test purposes because we need the conversion ratio.
Hmm.
We don't need the conversion price. The convertible bond price is driven by the common stock price. So after Starbucks issued this convertible bond, the stock went to 50. And so now what we need to know is, okay, well, if we can get 25 shares of a $50 stock, what is parity of the bond? The bond is now going to be worth more than $1,000 because remember, it was convertible at 40 and the stock was at 38, but now the stock is 50. So what we want to be able to do is calculate parity. It also, if it doesn't make any sense to convert, we'll trade like a bond. It'll be interest rate sensitive. Parity, that's our test question. It's when the value of the bond and the converted shares are equal. And to calculate parity, we need the conversion ratio. So parity of the bond, we're going to take the current market price of the stock, 50, times the conversion ratio, 25 shares, and we're going to get a parity of 1,250. Parity of the stock, we're going to take the current market price of the bond and divide by the conversion ratio. That is more likely. So here's an example of a test question. They'll say a convertible bond has a conversion price of 40. We say, bastards. We can't do anything with the conversion price. We need the ratio. They'll say, what is the bond parity price of the common stock is trading at 50? So we're either going to multiply or divide. If we're going for the bond parity, we're going to multiply. So we're going to take the common stock price, which is 50. We're going to times it by the conversion ratio. That may or may not be given. And when we times that, we get parity of the bond, answer to the question, 1,250. Now, in the secondary market for the bond, it's unlikely that this bond is going to be trading at or below parity. In the secondary market, this is going to be typically trading at a premium. So you say, hey, Dean, I missed out on buying that Starbucks convertible, man. Could have got it at par, convertible into 25 shares of the stock. And, I've been watching the stock and it's gone from 38 to 50. I'm thinking about buying that bond in the secondary market. I know, Dean, the bond is worth $1,250 as it relates to the stock. What would I have to pay for the bond? I said, well, right now, the current market price of the bond is $1,300. Again, that's given information. And we know that we can turn this into 25 shares of the stock. And I say, Gabby, for this to make sense for us, Starbucks would have to be 52. Right now, Starbucks is 50. So parity of the common, what we'd be paying for the stock, equal to paying for the stock, is 52. Right now, the stock is 50. So our minimum expectation would be the stock's going to go up another 2 points. So 2 parity calculations you might encounter tomorrow. The 2 you might encounter are parity of the bond.
Yep.
Or parity of the stock. Those are the 2. Now, what is the advantage to Starbucks? It makes their bonds easier to sell, more marketable, and it lowers the interest rate they would otherwise pay. What's the advantage to our customer? He gets the safety of the debt, but gets the upside of the stock in terms of suitability. Now, in the trust indenture, the covenants, promises between the issuer and the trustee for the benefit of the bondholder, I'm going to say, listen, Starbucks, if you pay a stock dividend or stock split, I want my conversion features adjusted accordingly. I'm going to want to have more shares. So here, if there's a 10% stock dividend, I'd say I'd want 2.5 additional shares, 10% of 25. So that's called the anti-dilution or non-dilutive provision found in the trust indenture. The trust indenture is, again, those promises between that. All right, so you had parity on your list. What else was on your list?
Yes.
On
Mainly like,
types of orders. Let's do that. Types of orders.
yeah, and mutual funds and then options.
All right. Well, options is a big thing. We're certainly not
I
going to.
know. I just wanted to review like the
Okay, that's fine.
big
But that's right. We're not spending the whole day together.
no.
Okay, because remember, you really should be getting on your game face, right? Getting on your, you're doing your psyche.
I don't know why these confuse me so much.
What's that?
I don't know why the order types, like that's one
Oh,
of
I
the
think a lot of people get hung up. They think there's a zillion types of orders, and there's not. There's only
yeah.
2 types of orders. That's it. Market order, limit order. That's it. Market order is I want immediate execution, the best available price. I'm not interested in the price as much as I am the execution. Limit order means I want to do business, my price or better. So market order means I'm going to show up, here I'm off grid. I'm going to buy a truck. It's no sense of urgency. I'm not going to show up at a dealer and use a market order to buy a truck. I want a
Right.
truck, but the price is more important to me than the execution. So that means I'll be shopping, right? Nobody has to sell me a truck at my price or better. So Dean may never end up with a truck. Mark order means Dean just gets fed up and I just walk in and I say, I'll take it. Right. And they said, well, Dean, we haven't even told you the price. I said, it doesn't matter. I'm not interested in the price, right? I'm interested in the execution. Now, a limit order, as a buyer, it means your price or less. I carry around a lot of cash, Gabby, just an OG guy I am. I have a binder clip. It's not even a money clip, it's a binder clip. And it has a bunch of $100 bills on it. And some days my brokers would say, Dean, are you buying the office lunch? I would say, I'm buying the office lunch on a buy limit. And I'd peel off 10 $100 bills. I'm saying I'm feeding the office if we can do it for 1,000 or less. If they come back and give me back 100, say, Dean, we got it done for 9. I go, great. If they come back and say they need another $100, I go, well, that's on you. I told you, I'm not paying more than $1,000. Now, if I didn't give my brokers to buy the office lunch, if I gave them a market order, oh my God, they'd be wheeling pheasant hunter glass into the office for lunch, right? So they say, Dean, we can't feed the office for 1,000 or less. I go, well, I guess we don't feed the office. Nobody has to do business with you. Your price or better. Seller means my price or more, right? So as a seller, if I can get a higher price, that's going to be great. The price is guaranteed, but not the filling. So as we said, if you do get execution, it'll be at your price or better. But again, that may never ever happen. It has a contingency. Those are the only two types of orders. Now, you can add more contingencies, but the more contingencies you add to your order, the less likely it is to get executed. So that's important for a client to understand that, right? I had a guy who gave me a buy limit on 1,000 shares at 18 on a Monday. It didn't go off. All orders are considered day orders. I called him on Tuesday. I said, would you like to re-enter that? He said, oh, it didn't go off. I said, yeah, nobody has to sell you the price of the stock at 18. Right now, the stock is 19. He goes, let's re-enter it. I called him Wednesday. I re-entered Thursday. On Friday, he said, Dean, are you literally going to call me every day and ask me to re-enter this order? I said, I am. I said, listen, if you don't want me to bother you every day, why don't you make it GTC? Good till cancel. If today we enter it is buy 1,018 GTC, you will not hear from me ever again about this order unless it gets executed, right? So, boom. Here are some examples of market orders and limit orders. So, in this first one, buy 1,000 XYZ at the market. I'm more interested in execution than I am price. Sell 1,000 at 35. I want 35 or more. And it makes sense that I have to put that order above the current market price. And what I mean by that is it would be silly for you to tell me that you want to sell this stock for, 33 when the stock's at 32, right? The stock would have to be somewhere between here. Very testable about where we place orders in relationship to the market price. I'll just make up a current market price of 33. This is where that slobs over bliss as a memory aid comes in. Sell limits go above the market and buy limits go below the market. So as a seller, your price or more. As a buyer, your price or less. Stop orders. We can add another qualifier or contingency. Here you're telling me if this, then that. No this, no that. I say if the stock trades at or through. So I say, hey, Gabby, open up me a new account. And I like that recommendation. Buy me 1,000 shares at 40. And you call me, say, Dean, you got the stock at 40. I go, thanks. I said, now, Gabby, I more than approximately $3,000. I'd like to stop the loss, stop the bleeding. at about $3,000. You know, part of successful investing, Gabby, is letting your flowers bloom, but more important, pulling your weeds. So, you know, I'd like to put a sell stop at 37. Bliss. Buy limit sell stops. Please note, I'm placing the sell stop below the current market. Gabby, if the stock trades at or through 37, pull the trigger, send me home. You said, well, Dean, I'm not sure you're going to lose 3,000 because we don't know what the next trade is. I understand that, Gabby. If it gets triggered, becomes a market order. I get it. You know, we get lucky, the stock goes to 80. I call you, I say, hey, Gabby, I don't need a sell stop at 37 to stop the loss. I'd like to move up that sell stop to protect our profit. So move that up to, you know, it's 80, put it at, 77 to protect our profit. We can also use a stop order to create a stock position. You know, my cousin was making his wife nervous, and she called me and she said, hey, Dean, could you get John a call? He's, you know, recently put our retirement plan online. He's making, playing video arcade games with our retirement money. I called him. I said, John, you're making your wife nervous. What are you up to? He says, Dean, I'm thinking about buying this 1,000 shares at 10. It goes to 40. I make $30,000. I said, well, look, I'm looking at a chart, John, and right now it's just stuck at 10. Why would you want to tie up $10,000 in a stock that isn't going anywhere? You know, what I would suggest, John, is putting a buy stop above the resistance line. You know, let's put a buy stop at 11. That way we're not buying the stock unless it trades at or through 11. There's no sense buying the stock or selling the stock when it's stuck in the trading range. Would I do that? And I said, yeah. That buy stop again goes above the market. Now, it becomes either a market order or a limit order. You can tell me, Gabby, if you want. Dean, if we pull the trigger, I want my price or better. I go, wow, Gabby, you're being kind of penny wise and pound foolish here because now you're adding another contingency. You know, with a market order, if it trades out or through, immediate execution. If you're telling me that when we pull the trigger, you want your price or better, uh-oh. The more contingencies or qualifiers you add to an order, the less likely it is that that order is going to get filled. Order may never be triggered or elected. I think of it as a suspended order. It may never become a live market or limit order. We may never pull the trigger. The first trade at or through, the order becomes a live either market order or limit order, two separate events. I'm watching a sell stop at 37. I'm watching CNBC. I watch the tape go by. I call you, hey, Gabby, I just saw my trade, 37. You say, Dean, that wasn't your trade. That was the trade that turned your suspended contingent order into a live order, two separate events. I can't tell you how many clients I had to get confused about that. So that's not your trade. That's the trade that turns your order into a live order. Let's look at an example of a buy stop. Now, whether you want a buy stop that turns into a market order or a buy stop that turns into a limit order, a buy stop is placed above the current market price. Where do we place this order? Please note we're following the convention. Here we're trying to stop the loss at approximately $200. Now, another arrow in your quiver is to buy a 35 call. And another way to protect a stock position is to have the choice to buy back the borrowed stock. So we have two arrows in our quiver, a buy stop or a protective call. Now I say on the test, the following trades then occur. The following trades then occur. And so we're looking at this sequence of trade, and we're trying to decide, does it ever become a live order? It never becomes a live order unless there's a trade at or through 35. So nothing happens at 34.75. Nothing happens at 34.90. Nothing happens at 34.80. Test question 35 on your test tomorrow. There won't be a little arrow there that says trigger elected. You have to bring that to the table. Two separate events. And the reason there's a question mark there is because, remember, it doesn't matter what that trade is, because now you have a market order. Immediate execution at the best available price. So that's an example of a buy stop. Here's an example of a sell stop. You say, Dean, I'd like to lose no more than approximately $300. Approximately, again, because we don't know what the next trade is. Two separate events. And whether you want a sell stop that turns into a market order or a sell stop that turns into a limit order, sell stops are always placed below the current market price. Please note it. We follow that convention. Our sell stops at 30, the stock's at 33. On your test tomorrow, the following trades then occur. We're looking for a trade at or through. At or through, it becomes a live order, two separate events. It here is becoming a live market order. An immediate execution, best available price. Nothing happens at 30.75. We're watching the tape on CNBC go by, and I see a trade of ABC at 30.75. The order is still suspended. It may never become live. 30.25, 30.01. On a number line, there's no way to go from 30.01 to 29.99 without trading through 30. At or through, it's now a live market order. Immediate execution at the best available price. So whatever that trade is, that's the customer's trade. You say, well, Dean, can I turn it into a limit order? I say, well, you certainly can, Gabby, but then you're being, I think, penny wise and pound foolish. Because now we got to be a little more careful. Because you may or may not accept that next trade. The more contingency or qualifiers the customer adds, the less likely it is that that order is going to get executed. So now you're telling me, buy the stock if it trades at or through 25, but I don't want to pay more than 26. You know, people get hung up on this. I was just tutoring somebody the other day. Go, well, what if it was a limit order? I said, they will tell you that. It will be specified. You don't bring extra stuff into the question. So your customer puts his buy, stop at 25, limit 26. Following trades then occur. Please note, we follow the convention. Our buy stops above the market price. Whether it's a buy stop that turns into market or limit, it's above. 24.75, nothing happens. 24.90, nothing happens. 24.80, nothing happens. 25, ding, 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 ding. Now we got to be careful because remember they said they want to buy it for 26 or less. So if that next trade is 26.02, no execution. Next trade's 25.99, execution. So we have buy stops, buy stop limits. We have sell stops. We have sell stop limits. And remember, the key here again is this idea about being careful when going through the sequence. If it's a straight buy stop or sell stop, trigger, execution. If it's a stop limit, trigger, and then your price or better. Right? So, you know, the more qualifiers, the less likely it is. So here we go. Please note, we followed the convention. We placed our sell stop below the current market price of 26. Nothing happens at 25.99 or 25.90, 25.75, 25 and a quarter. That could be 25 or 24.99. At or through becomes a live order. And now that next trade may or may not be acceptable. As a seller, you want 24 or more. So that next trade is 24 or 24.01 or 24.02. We would accept it. If that next trade is 23.99, we will not accept it. This memory aid device is really important about where we place orders in relationship to the current market price. And so the memory aid device is slobs over bliss, right? And we said whether it's a buy stop that turns into a market order or a buy stop that turns into a limit order, buy stops are above the market price. And whether it's a sell stop that turns into a market order or a sell stop that turns into a limit order, we place it below the market. All right, so we went over parity. We went over types of orders. What else was on your agenda?
Like mutual fund, like the math and like the formulas.
Okay. And then what else? Was there anything else?
I wanted to go over option, like the advanced strategy, just like briefly, like the formulas, like for spread and straddle, like
Okay.
maximum gain, maximum loss, break even. But
Okay.
then just like really briefly, because like I know that stuff,
Yeah. All right. Okay.
but then mainly like
Okay.
Yeah.
All right. So there are two situations that are going to show up perhaps as it relates to math on mutual funds. One scenario is when given the NAV and the POP, calculate the percentage sales charge. And that's important because remember, we come up with more than 8.5%, it's going to be a closed-end fund because 8.5 is our limit. The other scenario that we get might need to do some math on is when given the NAV and the percentage sales charge, calculate the public offering price. And so let's just say that we'll do the first one here. I tell you that the NAV is $9.15. The public offering price is $10. And I simply ask you on the test, what is the percentage sales charge? The way we do that is we take the public offering price, we minus the NAV to get our sales charge, and then we take our sales charge and we divide by the public offering. Ah, come on, Dean. I don't know why it's doing it. There we go. Boom, let's try that. Yeah, who cares? You know, adapt and overcome. So we're going to divide by the public offering price. All right, so boom. We're going to take our, let me get a different color here. We're going to take our POP minus our NAV, and we get our sales charge of 85 cents. And then we're going to divide that by a public offering price. As Dean always says, if you can't remember what math to do on the test,
Divide.
always, right? You got to decide what to divide, first number by the second number. Now, I might say to you, Gabby, so that's our first scenario. I might say, hey, Gabby, I know a way you can get this mutual fund instead of paying an 8.5% load. I know a way you can get it with a 6.5% load. And you say, well, geez, Steve, that sounds like a good deal. I go, yeah, because if you paid a 6.5% load, your public offering price wouldn't be $10. You know, so it behooves us to try and qualify for a reduced sales charge. So now the test question is, your client qualifies for a reduced sales charge of 6.5%. And now we got to figure out what that public offering price would be. So this is our second scenario. So the way we're going to do this is we're going to take the NAV, which is $9.15. Now remember, you can't go for that $10 here because remember the $10 was based on somebody who's paying the full load and did not qualify for a reduced sales charge. Right? So now we're asking, what would you be able to pay if you had a 6.5% sales charge? And again, we're going to divide. And now what we're going to divide is 100% or 1. There's a lot of ways to do math. Minus the sales load, because that's what's not going into the fund. Right? That's what my commission is in this transaction. Boom. And now we're back in business. This is a 93.5% or 0.935, however you want to think of that. It's, you know, again, math, lots of ways to do things. And where is Dean's calculator?
On
Right?
the test, do we have, do like, I can't remember if the calculator is like, has a
Exactly
percent.
like this. This is the exact version. I actually stole this one from the Prometric site.
Does it have a percentage on it?
It does. It's
Okay.
this exact calculator. It's exactly this calculator. By the way, I bought this calculator intentionally because it's like the ones I use at the site, right? So now we're going to take 915 and we're going to divide and we get 979. I say, ooh, you could pay 979 instead of 10. And that would be a great thing, right? To get that lower sales charge. So those are the two formulas. We said scenario number one is when given the NAV and the public offering price, calculate the percentage sales charge. We said the second scenario is when given the NAV and the percentage sales charge, calculate the public offering price. All right,
Yay.
you have two advanced option strategies. Two advanced option strategies. You have straddles and you have spreads. Right? I'm going to put one here on the whiteboard. And I want you to tell me whether you're looking at a straddle or a spread. Are we ready?
Yep.
Let me get a price of a stock here. Boom. You buy one apple March 250 call at 7. And you buy one apple March 250 put at 7. My question to you is that a straddle or is that a spread?
The straddle.
That's right. Test question number one is, can you identify a straddle? You've done that correctly. Test question number two, what are the break evens?
Okay, so I would add the sevens,
That's right.
and that's 14, and then I would subtract 250 minus 14, and then add.
Now, good news. Listen, I'm not being facetious. I'm terrible at arithmetic. So if somebody offers me a calculator, I'm saying thank you very much, right? So I'm going to take
Yeah.
250 plus 14, 264. You were correct, is our upside break even. 250 minus 14, 236 is our downside break even.
Yes.
So third test question. Where do you want the market price of Apple to be in relationship to these break evens?
Like outside of them.
That's right. You did excellent. Last test question about a straddle. When do you use a straddle? So what is your expectation here on Apple's stock price?
That you want it like to be volatile
That's
and
right. You expect up or down, but you're uncertain about the direction. You're buying non-directional volatility, right? You think either Apple is going to hit it out of the park with the new iPhone with AI, and if they do, the stock's going to roar, or you think, this is overrated. People aren't going to upgrade their Apple phones, and so I think it's going to tank. I don't know. I think it's not going to stay at 250, right? So built-in mistake here. So one of these. All right. So the other one you're held accountable for, is.
Wait, I have a question. I have a
Sure.
question.
Yeah.
About that one. I don't know if you can bring it back, but
Again. Yep.
okay, so I have the break evens.
Yeah.
Where I get confused is like how I found the maximum gain and maximum loss.
Well, because remember, you told me correctly, you want the market price of Apple to be outside.
Oh yeah, this is the easy one. So I know it's like a gain if it's.
Yeah. And then your loss, you should know that anytime you buy options, your loss is
Be
always
inside.
That's right. All right, let's do another one here. So, boop. Okay. So this is just really not smart, but hey, I saw one Apple March 250 call at 13. And that would be a foolish thing because that would be a naked call. So I say, you know what I think I'll do is I will put in a ceiling here and establish and boom, 250 call at 6. Okay, are you looking at a straddle? Or are you looking at a spread?
A spread.
You are correct. So that's test question number 1. This is a spread. Test question number 2. Is this a credit or debit spread? If you get this right, you can rock and roll.
So I know, so it's a debit spread.
This is
No,
that's money in.
dang it.
This is money out. So the way you determine whether it's a debit or credit spread is you net the premiums, right? Whenever you have a buy and a sell, you're going to net, right? That's a big important. Buy, like in that straddle was a buy, you add. I think the way you were to say, I think in our last session, you were talking about same different action, I think is what you said.
Yeah.
Right. So when there's different actions, you got to net. Okay. So now we're back in business. You missed it, but you shouldn't miss the next one. This is
No.
Brett. Do you want these contracts to expire or be exercised?
Expire.
You'll be right every time. Yeah, I'm hinting, don't think about it till you get the menu done, right? You can say, yeah, I think I'd be happy. By the way, I think you're kind of a jerk of a customer. You say, well, Dean, had I done the naked calls, I'd made 13 instead of 7. I say, yeah, but you would have been taking all kinds of risk. Do you want the difference in the premiums? Spread means difference. Do you want the difference in the premiums to widen or narrow?
Narrow.
You'll be right every time. What does the gain and the loss always add up to? In a spread, the gain and the loss always equals the difference in the
The
strikes.
strike prices. Okay.
Right? There's only 10 points to be made or lost, and you've collected some of that money already. So the next thing we got to know is our max gain, max loss. Well, we collected 7. So our max gain is 7, and our max loss is 3. The gain,
How do you know that you collected 7? Like, how do you know that that's your gain?
premiums. You net the premiums, right?
Is the net premium always the gain?
If it's a credit, if it's a debit, it's a loss,
Okay.
right? So when you net the premiums, you're either establishing that it is a debit spread or it is a credit spread. So once you get this net number, it's either credit or a debit. So it's either going to be your max gain or your max loss,
Okay.
right?
And then the other number is
Right.
the other one.
Exactly right. It would be bad for him to tell me on pick any two numbers that don't add up to 10, because that's the whole point of a spread. You're saying I'm playing here between the floor and the ceiling. All the action takes place between the strikes. Okay, so now we need our break even. Now we know our break even has got to be test taking trick as well. We know our break even has to be somewhere between these two numbers. We can eliminate anything offered to us that isn't somewhere within that range. So are we going to use cal or push?
Cal, because call add lower.
Right on. So we're going to take our lower strike.
Oh, that's why I should have known that. Okay. I was thinking when I was at the beginning, I was like, call add lower. And I went, oh, 6 is lower than 13.
No, it's the lower strike. So
The lower strike.
So what we're adding here to the lower strike is our net premium. So boom, we take the lower strike, which is 250. We add the net premium, which in this case is 7. And we get our break even of 257. And as I said, don't think about it until you get this menu done, but it makes sense, right? What I mean by that is if you buy the stock at 257, deliver at 250, you lose 7, you got 7, you break even. The last thing we got to do is determine whether this is a bullish or bearish spread. Is this a bullish or bearish spread? The way we do that is the larger premium dominates the position. The larger premium dominates the position. So in terms of our matrix, we're trying to figure out what sandbox we're playing in, right? So we're playing in that sandbox. If we had our matrix here, there's our matrix. And in this sandbox, we're a 13. And in this sandbox, we are a 6. So what sandbox are we actually in? We're in the short call box.
Bearish.
This is a bearish spread. All right, so there you go, young lady. So there's our hour. Now you have a decision to make. A lot of people find tutoring replays very helpful, and I think you did very well, and I think you're going to pass tomorrow. And if you would like to not pay me $250, I will just have your permission to share this video with others. If you don't want them to do that, that's fine. Then you will meet.
Yay!
So what
Yes.
would you like?
Yes, you can share it. I hope I don't
All
look
right,
like a
okay.
lunatic
All
after.
right, there you go. Okay, so anything else before we? By the way, I'm teasing you a little bit.